Is Energy Transfer a buy or a sell? Let's get started with the model. This is a large cap company, 59 billion market cap. They're trading at $17 a share and they have 3.4 billion shares outstanding. ET owns and operates natural gas pipelines and natural gas storage facilities. They sell natural gas to utility companies, independent power plants, and end users. It also owns 5,700 miles of natural gas liquid pipeline, NGL fractionation facilities, and NGL storage facilities. It was founded in 1996, headquartered in Dallas, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how high their free cash flow was in 2021, 8.3 billion. It did come down 32% in 2022 to 5.7 billion. A nice growth into 2023, 6.4 billion, up another 4% in trailing 12 months, 6.7 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 2021, down to 3.9 billion in the trailing 12 months. Revenue is a sales for the company, and they're number one in revenue for midstream companies, almost 90 billion in 2022. It did drop 13% in 2023, up another 6% in the trailing 12 months. Look at that yield, 7.4% dividend. That's if you buy the stock today. I bought it 2 years ago at half the price, so my yield is 15%. They can afford that dividend. They can cover it 1.5 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value to all cash flows past year 4, that's 106 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $94 billion. We divide that by 3.4 billion shares. And we get a calculated stock price of $27. They're trading at $17, so they're trading at a 37% discount. It's a pretty strong buy according to the model. This stock always seems undervalued. What do you think? Do you think it's a buy or a sell? There are 45 companies in the same industry as ET, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount of CapEx, $3 billion, because not only do they have to add pipelines and infrastructure, they have to maintain what they currently have as well. So probably half their CapEx goes just towards maintenance. TC Energy spends the most in CapEx, $5.2 billion. TC is a Canadian midstream company. Enbridge is the biggest Canadian midstream company. They're also the biggest midstream company. ET's debt to equity ratio is between the median and average. For every dollar of equity, they have $1.70 of debt. DT Midstream is the best at 0.6. DT stands for Detroit. ET pays a nice dividend, 7.4%. Frontline is number one at 10.1%. They generate the most free cash flow, even more than Enbridge. More than double the Williams Company. They generate more than Enterprise and ONEOK combined. They rank 5th in market cap. They should be number one. Price to book 1.7. PE is 15, which is pretty close to the average. Look at that price to free cash flow, 8.8. What an attractive ratio. And they trade below revenue, which means their revenue is higher than their market cap, and their 5-year annual revenue growth rate is 9%. I'm up 100%. If you include the dividend, 150%. But if you put $10,000 into this company 10 years ago, you would not be happy at $6,200 today, a 38% loss. But look how much it came down at a couple of points. You could have got it at a great value. So to summarize, I have them trading at a 37% discount, ranking 10 out of 10. A great stock, a great company. Would I buy at 10 out of 10? I probably should pick up more. Ratios are good, 8 out of 10. Financials, not so great. Their free cash flow is down 20% since 2021. Revenue is up, but it peaked in 2022. So it is down from that point. Let's take a look at their third quarter earnings results. In July of this year, they completed the acquisition of WTG Midstream. This is going to add 6,000 miles of pipelines, which will extend ET's network in the Midland Basin. The Midland Basin is the eastern part of the Permian Basin. It's in West Texas. Lots of oil in Texas, as you probably know. This transaction also added 9 gas processing plants with a total capacity of 1.5 billion cubic feet per day. Here's some more info on ET's website. They paid $3.25 billion for this company, so it's a pretty big acquisition. When there's a B involved, that's pretty significant. And it talks about the highlights, expands ET's natural gas pipeline and processing network in the Permian Basin, includes 8 gas processing plants and 2 more under construction, adds 6,000 miles of pipelines, includes a 20% ownership interest in BANGL NGL pipeline. Here's a page on BANGL pipeline in case you want to know what it is. The pipeline is going to run from the Permian Basin to the Sweeney, Texas area. Its parent companies are this company, Whitewater, West Texas Gas, and Rattler Midstream LP. Its capacity is 125 barrels per day. That's the amount of liquid that can pass through the pipelines per day. It's 525 miles long, and it is operating. With the acquisition, ET owns 20% of BANGL, natural gas liquid pipeline. ET was really busy in July. Also in July, ET and Sunoco formed a joint venture. The joint venture combined their crude oil and water gathering assets in the Permian Basin, and ET operates that joint venture. Last month, the company announced a dividend of 32.25 cents. If you annualize that, it's $1.29. Here's their third quarter income statement. Revenue $21 billion, almost identical to last year. Cost of goods sold $15.6 billion, a little less than last year. And then they have operating expenses and depreciation. So total expenses $18.5 billion. Operating income $2.2 billion, similar to last year. They do pay a lot of interest, $828 million of interest on their debt. So their net income $1.4 billion, up from $1 billion. The reason their net income was lower last year was a $625 million loss on litigation. They did add a lot of shares. Last year, 3.1 billion shares outstanding, now 3.4 billion. But you should really focus on earnings per share. Actually, it's earnings per unit because they don't have shares, they have units. It's an MLP. So earnings per unit is more than double last year. So last year, if you own 1 share, the portion of your net income was 15 cents. This year, the portion of your net income is 33 cents. So even though there's more shares, there's more dilution, they doubled the value of the profits from last year to this year, more than doubled. Let's look at the balance sheet. Current assets $13 billion, current liabilities $12 billion, so current ratio above 1, that's good. They have a ton of PP&E, $95 billion. That's the value of their pipelines and their facilities. So total assets $124 billion, up from last year, $113 billion. They have a lot of debt, $59 billion. That's why they paid so much interest on their debt. Assets minus liabilities equals equity. Total equity $46 billion. They raised $31 billion from selling common units. I own common units, but they also raised $4 billion from selling preferred units. Here's a breakdown of their adjusted EBITDA. $3.5 billion in the third quarter of 23, $4 billion in the third quarter of 24. EBITDA is earnings before interest, taxes, depreciation, and amortization. And to calculate their EBITDA, they add their investment in Sunoco because ET owns the Sunoco retail gas stations, the ones in the US. Sunoco is a publicly traded company, so if you just want to invest in the gas stations, the ticker is SUN. And that company has a market cap of $7.2 billion. They also own part of USAC. That added $146 million to their EBITDA. If you want to invest in USAC, you can do that. Ticker USAC. USA Compression Partners. The market cap for that company is $2.7 billion. They do give a breakdown of the $456 million for Sunoco. Here it is, investment in Sunoco. This is the third quarter of 24, this column. Revenue $5.75 billion. If we go back to Yahoo Finance, type in ticker SUN, go to the financial section, we can see in the third quarter of 2024, revenue of $5.75 billion. That's for the entire company. So here's SUN's actual income statement for the third quarter. Revenue $5.75 billion. Cost of products sold $5.3 billion. Let's look at a stock on Simply Wall Street. Its last price $17.59 billion market cap, up 5% in the past week, up 32% in the past year. Here's where the stock price sits and started trading in 2006. At a few points it was below $5, 2008, 2016, and 2020. Its peak was in 2015. That's not a coincidence. It's when oil prices were high. And when oil prices come down or crash, so did this stock. So if you had a foresight of picking it up when it was in the single digits, below $10, you're probably doing pretty well. But if you bought it north of 20, it could take a really long time to get back up to where you bought it. Simply Wall Street's valuation is 24. They say the stock is 27% undervalued. 17 analysts priced this stock at $20. They also say it's undervalued. Here's a look at their revenue since 2013. They currently generate the most revenue of any midstream company. It was $48 billion in 2013. It fell to $30 billion in 2016. Then it came back up again, came down around COVID time, and it peaked in 2022 close to $90 billion. It's not far off. It's $84 billion currently. These numbers are for the trailing 12 months. They do have quite a bit of debt on their balance sheet. It was $23 billion in 2013, and it goes up each year, currently $60 billion. It seems like equity is always a little lower than their debt. They move in the same direction, but equity always trails it. So their debt to equity ratio is 127%. And they only have $300 million of cash on their balance sheet. Here's their dividend yield since 2015. It looks like a roller coaster, right? It was 3% in 2015, then got up to 15% in 2016, down to 6% in 2017, up to 20% in 2020. The reason the yield gets so high is because the stock price comes down. If the stock price goes up, then the yield goes down. Also, the yield goes down if they cut their dividend. This says they did not pay a dividend in November 2024. But you can see they did pay a dividend of 32 cents. I guess the chart is just wrong. The CEO's salary went from $1 million in 2017 to $1.4 million currently. Total compensation, $17 million, 10-year CEO, 4 years. And there's been insider buying, no selling. Kelsey Warren, the founder, he bought 3 million shares. So insider shares bought in the past year, over 6 million. 56% of the company is owned by the general public, 34% by institutions, and 10% by insiders. The biggest shareholder is Kelsey Warren, 8.8%. Then Blackstone, Alps owns 2%, Harvest 1.8%, Invesco, Goldman Sachs. And you can see there's a lot of big companies and funds that own the stock. Natixis, Chickasaw Capital. Their employee count was much higher in 2016, 31,000. Now it's down to 14,000. And the ticker trades on the New York Stock Exchange. So if you want to learn about master limited partnerships, click on the video in the top right corner. Thanks for watching.